And we're getting to a keynote presentation now. It's Andrew Miller from Benchmark Minerals Intelligence, a group I highly, highly regard. They're the absolute leader when it comes to tracking what is happening in the lithium and battery metal space. They can tell you up to date what is happening, who's building, how many gigawatts of battery capacity are coming on and when. So I'm really excited to have Andrew on, and because the quality information doesn't get much better than this. And that's the whole goal of this SF Online session, to really give you an overview of what is happening in the space and where we're headed. Andrew, I'm extremely excited to have you on. Thanks for joining us this morning.
Thanks very much, Kai. I really appreciate that introduction. Let me just share my screen and I'll hopefully to walk you through the presentation. Can you see that now, Kai?
That looks fantastic. Thanks so much.
Great, thank you. Well, yeah, really nice to be here today with everyone. Appreciate that introduction again. Thanks, Kai. And what I'm going to talk through today is really what we see as the build out of this lithium ion economy that's really gathering pace, has been for a couple of years now, but is going to see really fundamental change across a number of minerals and metals over the years to come. First of all, just for those of you who aren't familiar with Benchmark, we were established back in 2014 with the specific goal of providing independent and accurate market intelligence and pricing information for the lithium-ion battery supply chain. So everything we do is focused along the supply chain, working from the group of what we see as the most key critical raw materials, your lithiums, cobalts, nickels, graphites of the world, through to the anode and cathode application, right up to the battery cell and application into either electric vehicles, portable devices, or stationary storage applications. So we provide a number of advisory and research services, stretching from our price assessments through to long-term supply demand, price and cost forecasting. And for those of you who need something a bit more bespoke, we also offer consultancy. So feel free to reach out to myself at any time or any of the team if you do need any of those bits of information. So I just wanted to kick things off today by talking about, where we are with electric vehicles. Electric vehicles are, of course, going to be the driving force of the lithium-ion battery market over the coming decade, at least. And really, we're at quite a turning point for the lithium-ion battery market, in the sense that EVs are now seeing a convergence of both policy and industry. Obviously, policy has really driven things forward in the past, particularly within China, which has been a leader in this space for some time. But now actually coming out of COVID, and one of the positives to come out of COVID from an EV market perspective is that a lot of the stimulus efforts being put in place, whether it be in Europe, whether it be in North America, are very much focused, of course, on this push towards clean energy and the push towards electrification. So policy now, on a more global perspective, is backing up what's happening at an industry perspective with the massive rollout of new electric vehicle models from all of your incumbent automakers, the VWs, BMWs, GMs of the world have all made really significant commitments to expand their electric vehicle offering, but also some of the newcomers entering the market. Obviously Tesla less of a newcomer nowadays, but you see the companies, the likes of the Rivians, Proterras in the bus space, and new companies emerging which could be potentially disruptors in certain segments of this electric vehicle market. So all of that momentum is pushing forward the case for not just EVs, but of course lithium-ion battery demand. And what that looks like, when you look at the uptake of vehicles, and again, just going back to the point about how, one of the positives from an EV market perspective has obviously been this push that we've seen from the second half of last year, is that you've typically over years had seasonality in EV demand, that being tied to the policy measures in China and the sort of end of year rush to register new vehicles before reduced subsidies were to come into place. And that's what you were sort of seeing in 2019, where there was less seasonality because subsidies in China had reduced to the point where there wasn't that real rush towards the end of the year. Importantly now, I think in 2020, 2021 onwards, what you're seeing is that there's a huge push, but I don't think this is going to be as much of a seasonal factor. This is a rush on electric vehicle demand coming out of COVID, and obviously penetration rates as a proportion of all global auto sales increased significantly last year because of the total decrease. But looking into 2021, and you see in the first 3 sort of months of this year, and this can be carried through to May now, you're seeing significant year-on-year increases in global demand. And what that is really being driven by is that this is no longer a China story, no longer focused on just policy. But as I say, industry is now coming up, the number of models available, not just in Asia, but in the rest of the world, world is expanding, almost weekly at this point, and we're seeing a huge push, which we think will see continued momentum, and not so much of a seasonal rush towards the end of the year, but continued high consumption levels, particularly as you see the emergence of Europe this year, but a bit further down the line, the growth in North American demand as well. So when you look at things from a battery perspective, and coming back to Kai's point, what you really want to know is how many gigawatts are being built out. What's needed to support this push towards electrification in vehicles. And what this graph here shows is the growth in what we call the mega factories. These are gigawatt hour scale production facilities for lithium ion battery cells. And what you see as that timeline sort of moves along is a huge amount of investment, particularly 2018, 2019 was going into China. China led the way, as it still does today, but more importantly, what you've seen is some more diversification of that demand outside of China. Not all battery cells in the future will come from China. Obviously, for the automakers in Europe, North America, there are supply security issues, and there's a need to have more of that production being taken place locally, which would, of course, have a big bearing on the flow of trade of your raw materials into those battery producers. But this graph here really just goes to show the number of these facilities. And if you look at this from a scale point of view as well, these facilities are just getting bigger in what companies are targeting. So it's not just about them expanding in number or in areas of the world, it's actually the scale of these operations is increasing at the same time. So all of these positive headwinds for the market moving forward. And as I mentioned, just honing in on what's happening in Europe and North America very briefly, because this is really critical to the emergence of new supply chains developing right back through to the raw materials. And I think Europe's a perfect case study of how in a very short amount of time, through government support, through industry partnerships, you can see some real positive steps in terms of the build out of new battery capacity. That's sort of one step up the supply chain. And over time, we'll continue to see that work its way towards the raw materials. But what we've seen at the battery level is when these partnerships and these commitments do emerge, they're far more certain. The financing and the backing from an industry perspective is there, typically with partnerships. And the scale of the plants is actually much larger than you may be seeing in China and other parts of Asia at the moment. So this graph here shows that some of these big European facilities that are being planned, the ones you would have heard about with your Teslas, Northvolts, SK Innovation, if you look at the average scale of those facilities, is typically that bit larger than what might be happening in the rest of the world. And you also have a number of newcomers in Europe. So it's not just relying on the battery incumbents, whereas when you've seen investments in battery cell production around the world outside of Asia, it's typically been led by those Asian incumbents. An interesting trend in Europe is that you're seeing a lot of these newcomers emerge, looking to disrupt that sort of those market leaders and cement their own position in a more regional context. So Northvolt obviously being the big name there, but more recently you're seeing the likes of Britishvolt, Freya really make some significant commitments, significant partnerships, and attracting significant investment to push those projects forward. And then what you're seeing in the US, slightly behind, as I say, Europe has very much been a case study. The US is maybe 18 months, 2 years sort of behind where we see Europe. But obviously all of this started with that build out of the Hub 1 that you see with Tesla and what they did with Panasonic and at the Gigafactory. And that sort of sparked all of this momentum towards the lithium ion economy into place. Now you've started to see a few other hubs emerge around Texas, and that's up there, and also around Detroit. So a few interesting new hubs to watch on the US side, but capacity is that bit further behind what you're seeing in Europe. So bringing all that together, what this fundamentally means is that there's a huge mountain to climb. If you add all the expansions happening in China, Europe, North America, and everywhere else in the world, there's a significant mountain to climb for your raw materials. This is the growth trajectory of lithium-ion battery demand. And just out of, for reference, the orange line that you see here is our forecast pre-COVID. So what you're actually seeing is that COVID actually only forced things to be lower than our expectations in 2020. Every year from this year onwards, we actually see that the demand growth being that bit larger than what we were anticipating pre-COVID. So really underlining the fact that coming out of this global crisis, the EV market has been one of those industries which has benefited from some of the policy measures that have been put into place. So from a raw material perspective, that means there's a huge mountain to climb, and there's going to be perpetual change across these raw material industries over the coming decade. I picked lithium here as the case study just because lithium is the sort of mainstay material across your batteries. Obviously, your cobalts, nickels, used in varying intensities across different types of technology, but lithium is pretty consistent across all and really tells the story which all of these raw materials are going to be facing. But if you look at the lithium market, and what I've shown on the left-hand side here is our supply forecast through to 2030. Now, what that shows is that if you just rely on the existing operations and expansions from those existing operations that are already in production, you'd see supply grow by about 7% across the decade. In the best case scenario, if all of those new projects under development are able to finance, bring production to market, and ramp up within the time frame that we're anticipating, that would see supply grow at about 14%. This compares to demand growth that we're anticipating at closer to 20% for lithium. So what you see is there's still a gap to be made. Even in the best case scenario, there's still a gap to be filled. And ultimately what that means, unfortunately, and you see this on the right-hand side chart here, is that, we do anticipate each of these raw materials are going to face significant structural issues. There's going to be major bottlenecks that come about in different timeframes for each of the raw materials. But ultimately, huge investment needs to come in to prevent this type of deficit emerging. And the reality of the market in the short to medium term anyway, is that even if the money comes, even if the partnerships are there, the time to develop these assets, bring them to commercial production, be producing a battery grade chemical and have that qualified into the supply chain of these battery producers is significant, and nothing can be done overnight. We're talking about a multi-year process. So money needs to start going in now to address some of these structural issues of 3, 4, 5 years into the future. So all of that is actually being curtailed. You would think all of this positive momentum on the demand side, all of these questionable structural issues on the supply side would see, a huge influx of money. And it's beginning to see that capital come in, but not at the rate and speed required. And the first constraint that we've seen on the capital side has really come off the back of the past couple of years, where actually the pricing for these raw materials has fallen off. New expansions came in and maybe overshot where demand was in the short term. And while that new capacity is very critical for the longer term perspective of the market, what it actually did in the short term was bring prices down quite significantly for the likes of lithium and your cobalt, which obviously limited the money flowing into the sector. A couple of other big issues to address in the build out of these new production facilities. The first of those is COVID constraints. So a lot of new projects under development, as I'm sure has been talked about on this call and everyone's aware of, the lack of travel, the lack of ability to get people to site to push these projects forward has been hindered by what's happened, of course, over the past 18 months. And that's still something that's ongoing today. You look at projects in Australia, travel isn't easing up massively in Australia. You look at other parts of the world that are very critical to the build out of these supply chains, and they're under constraints by getting people out to site, pushing these projects forward. And that skill constraint is obviously, added to and compounded by this possible emergence of a new commodity super cycle, which is potentially taking skill sets away and skills away from these smaller markets and directing them towards some of your bigger commodities, which are obviously going through significant growth themselves now. So, a number of issues that in the short to medium term really have to be overcome, not just financially, but in terms of actually getting these projects up and running. And when you talk about, coming back to the point about the build out of this supply chain away from its existing foundations, I think it's really important to point out that, while it's really positive that the major battery producers are seriously looking and the governments are looking at how you build out this supply chain locally and in the most sustainable way possible, that just adds additional hurdles to bringing new projects in line to serve the European, to serve the North American market. And when you look at, China and the way it's built out its lithium-ion battery supply chains over the past decade, not having those hurdles in place, or not to the same extent. Of course, I'm not saying, that they're not concerned about sustainability in China, but perhaps not to the same extent that we're seeing the governments in the US and Europe focus on today. What that's meant is that they've been able to build out capacity at a much faster rate and to a much greater scale than obviously we see in Europe and North America today, but quite possibly that we see in the future, because the hurdles to bringing new production to market are only growing.
Right.
So I'm not sure if I'm coming to my time. I don't know. I heard some noise there. If I'm coming to my time, Guy, just butt in and I'll be quiet. Final few slides. The first of those is where is this material going to come from? It raises the big question about, if you keep showing these structural issues, is this just going to be a bottleneck the industry can't overcome? The real answer to that is that, on the whole, these raw materials aren't geologically scarce, but finding them in the right type of concentration, finding the right types of deposits where the technology is in place to expand and produce a battery-grade chemical is limited today. So the upshot of this is that disruptors in this space, and when you look at companies developing new technology, extracting from new types of resources or new parts of the world, we can't be skeptical to that. Because it hasn't been done before doesn't mean it isn't going to be very much needed in the future. So you can look at what's happening in nickel and the questions about, how much comes via MAT, the HPAL process, right through to your lithium in terms of how do you get to those battery-grade carbonate and hydroxides? Is it through brines, spodumene, or are we going to start to see the emergence of clays and other types of assets? And we're very much of the perspective that you will see an expansion, not just geographically in these raw material supply, but the types and the processing routes to get to your battery-grade chemical are going to have to evolve as well. And another key part of that, and I think when you look, this is for a whole separate conversation, a whole separate presentation, but I think a really interesting perspective on this is how do you incentivize and how do you build out the recycling capabilities that are going to be mandated in this market in the future. We're not talking about batteries the size of your phone anymore. We're talking about batteries the size of a car. And when they do come to the end of life, they can't sit in your cupboard at home. They have to go somewhere, and we have to start re-extracting those key materials so that we're not completely solely dependent on mined material in the future. But a lot to be done in this space, and as I say, a whole presentation for another day, I'm sure. So a few final realities from a raw materials perspective. I think the first of those realities is that you don't have to be the lowest cost producer to bring a new asset into production anymore. These markets are facing such a steep growth trajectory in terms of demand that there's a huge spectrum of producers that are going to be able to enter the market. And as you see in the case of lithium here, where you're looking at, if you look at the cost curve to 2030, a lot of the new producers between now and then are going to fall, in the middle part or to the lower or to the higher end of the cost curve. And that doesn't mean that there's not a place for those producers in the market in the longer term. The fundamentals are changing. We can't just work towards from the existing supply bases, and we have to develop new areas for this supply chain. The second of those realities, and I'm hoping this graph will work, it does, really just underlines the fact that I think, off the back of that adoption in pricing, that you're going to have to see on the whole that these prices are going to rise over time, and you need longer run incentive pricing to bring these new operations into the market. And this is really key, not just because obviously the cost curve will change, but most importantly, when you look at these prices, everyone talks about the emergence of lithium-ion battery demand coming from this gradually and continually decreasing line in battery costs. Now, of course, that isn't sustainable. When you get to the $100 a kilowatt hour level, the raw materials are making up a significant proportion of that total cost. And the key point here is that you can't see the massive fluctuations and volatility in the long term that you've seen in these raw materials, because it's not going to be sustainable for the battery producers. There needs to be prices which incentivize new producers to come to market, but aren't as volatile and as uncertain that as to detract from that future demand. So a huge issue on the pricing of these raw materials, and that's going to become of growing importance as we try and bring battery costs down. And finally, everyone talks about these raw materials as sort of one thing: where you're going to get your lithium from, where you're going to get your nickel from, etc. The key point about this is that no impurity profile for two consumers of these battery grade raw materials, which are ultimately the cathode producers, are the same. So, it's really still about not so much a commodity mindset of bring it to market and make it meet one type of specification. You're going to have to be able to refine and tailor your material for different consumers, but more importantly for different types of technology. And increasingly, as you've seen emerge in the battery side of things, you see this almost tiering structure where certain end users are happy to work with certain battery producers. You're going to see a similar thing continue to emerge in these raw material markets. The certain producers will be seen as the higher quality, and for that reason can go into a wider section of the market. So it's not one thing, and these new raw material producers are going to have to be flexible in what they actually bring to market. So I hope I haven't gone too far in my time there, but if we have any time, happy to answer any questions, Kai.
No, fantastic. We do actually have about 8 minutes left, so that's fantastic. I do have a couple follow-up questions as well, because this is such an interesting space, and I'm just starting to wrap my head around it again. Being focused way too much on precious metals, I have to admit. But I had the fortune of meeting and doing some work with your colleague and boss, Simon Moores, back in the day in 2015 when he just was starting out. So really great to see you guys advance and being able to present at G7 in front of the Senate committees and all that in the US. Fantastic to see that. But some more specific questions. Like you said, Europe is ahead by 18 to 24 months ahead of the US. Why do you see that, and why is that? Is that just tax incentives that triggered that, or what is it?
I think that came more from the industry, to be honest. You saw those, major automakers, the VWs of the world, who obviously, coming out of Dieselgate and coming out of some of those other regulatory issues that emerged for automakers, really seriously announced massive expansions in what they were going to do in terms of EV models. Like many of these companies in this space, they made huge announcements about what they were going to do without quite coming to the reality of where their supply chain was and what that meant from a supply chain perspective. So the first step and where they're most comfortable is making solid commitments and partnerships with the battery producers. They're their final suppliers. What we're seeing, and where they're potentially even further behind when you look at Europe and North America, is that when you look beyond that to the anode, to the cathode, to the actual raw materials, they're still trying to get to terms with how much of this can we realistically source regionally or nationally, and what does that mean in terms of how we direct investments or where we're actually doing this car production. So it's really been where the automakers are leading this, and where they put some partnerships in place has really pushed battery projects forward.
Interesting. And I'm going to ask a question from the audience that's in the chat here. And Andrew, OEMs and other downstream seem to be relying on incumbents, new tech like DLE or sediment hosted, and recycling to meet demand. Is there not room for conventional newcomers?
So I think there's definitely room for newcomers. You're right that the industry today is very dependent on the incumbents. That comes back to the point I made about qualification, right? Qualification is really key to this, and being able to adapt what you're producing, refine that for your end user, it is critical in being, an adopted and a trusted supplier in the supply chain. And the fact of the matter is that whether you're talking about lithium, whether you're talking about, cobalt, to a lesser extent nickel, but when you talk about the battery grade stuff, you're working from a very small pool of producers ultimately that are able to produce that final battery grade chemical, and that have demonstrated it over time. So yes, they very much want to tie themselves to those ones they know can do it. But the reality of that is that there's only a finite amount of material that those incumbents can produce, and ultimately there's much more demand outside that. So yeah, there will be room for definitely new technologies and newcomers.
Okay. One perception I had for years and years, and it's slowly changing, is that in the lithium space, there are 4, maybe 5 now big producers that can sort of fulfill the demands of the space. Is that still true, or do we need to see lot new production come online and make change that?
Yes, I think you definitely need newcomers to come. You look at those 5, like you say, the 5 leaders in lithium. You can look at their most ambitious of targets, and we're still looking at major issues over the coming decade. It's not that what they're looking to do today. I do expect that some of those producers, and we've already seen it in certain cases, will partner with some of the newcomers, or give them, maybe the newcomer does more of the raw material production, the existing producers do more the chemical side of things. I think there's going to be a huge room for that type of partnership. But no doubt you'll need new types of companies come into the space and new types of assets to be developed. Like I mentioned, either clays, geothermal brines. The two streams of the supply chain today are not going to support the future.
Let's talk geography real quick, because a lot of it is coming out of South America, of course. Where do you see new supply coming from?
So the US has a huge amount of really positive new projects that are being developed in the US. You have to look at Australia. Australia's been a leader along with South America. And I think if you look around those production hubs of where they are today, there's more to come. There's more to come on the spodumene side in Australia. There's more to come from the brine side, in particularly in Argentina, where you see a huge number of developers. But I would say, the US has some really good quality prospects. There's a few popping up in Europe and other parts of the world and parts of Africa as well. But I think when you look at in our models, when we're looking at where's next, really it's Canada and the US that have the best short-term potential anyway.
Interesting. Capital constraints is a big topic as well. And of course, I'm primarily focused on the junior mining sector, and we're massively capital constrained, in my opinion. You just look at companies that are trading at 100 million market cap that need to raise 3 billion. There's a disconnect there. And why do you see that is actually, like, for me, one perception in junior mining, especially, a lot of investors have been burned early in the cycle, meaning in 2015, 2016, a lot of run up. We've seen it similar in the uranium space. That's why Mark Anderson just mentioned it. Once there was a price increase, we saw all this, and 700 companies of those were maybe 50 were viable, but they burned through that capital that was needed from those 50 companies. Is that one of the reasons? And how do we see that problem solved?
Yeah, I do think that is one of the reasons. I think the only real way to solve that is a bit of a change in mentality. And you do see some of those producers who come out of, that they've gone through the 2015 to 2017 and then ridden the road through to 2018, 2019, where things fell off a bit and are still there. And I think it's having that more longer term approach to this, because we're undoubtedly, when you look at lithium and cobalt, you're entering a new price cycle. That price will continue to go up again, and that will obviously push things forward and make the investments a bit more attractive. But I do think, in the past, you've needed a longer term perspective, because we were never going to be at that sort of 1 terawatt hour, or that holy grail of mass scale EV adoption in 1 to 2 years, right? This is a much longer term thematic, and to really benefit from the investments in those at the raw material level, you have to be in it for the long term. And now we're at a point, I really think, like I say, with that meeting of policy and industry, we're at an inflection point now where the growth is so big now that, even if we're 10-20% out either way, or 20% higher than where it actually ends up being, you're still facing massive structural issues, and it's not that growth trend isn't going to go away anytime soon.
Yeah, Andrew, I could talk for hours with you. I got a couple more questions to follow up. One is, do you see battery manufacturers actually go downstream and buy mines and integrate that, or will they always be just buying from those projects? Do you eventually see capital flowing from the battery companies into the mining companies? Do you see that happening? Do you hear conversations like that?
Yeah, I think, for a lot of the automakers and the battery companies, it's always sort of been a step too far out of their skill set, out of their comfort zone to really do that. But you see what the likes of Tesla are doing, and going all the way to lithium conversion, or even lithium mining, as they sort of vaguely outlined on Battery Day. So there is more potential, and I think what you're more likely to see is sort of partnerships where throughout the supply chain, certainly from the battery producers, they're getting far more involved in the technology at a cathode level. And when you get to the cathode level, that's the anode level, that's the buyers of these raw materials. That's who's dictating what specifications are we going to need, what type of material do we need, and really how does that narrow down the pool of material we can use. So I think a lot more integration. Whether anyone's really wants to put up the money to go all the way to mine is another question. And really have to look at the midstream of this, the battery cells and the cathode. Those are the guys whose margins are constantly under pressure, right? Everyone wants lower. So the automakers that might have money to put in, whether they're comfortable enough to go all the way to mine is another question.
Okay. Let's end. We have 30 seconds left. Let's end with some actionable advice. What should our investors look for when they see a critical materials company come to market, or they look at it? Is there certain things that they should look at?
Yeah, I think a good jurisdiction that's going to allow them to develop in a short amount of time. You know, we're in a race against time now for a lot of these raw materials. So definitely a good jurisdiction where you're going to be able to develop something relatively quickly, and any partnerships or management experience that's really going to push the case forward and allow them to enter the market that bit more effectively.
Fantastic. Tough to find management teams with experience, though.
It's
Very tough.
not many people have done it right in the past, so that can't be the only thing you look for. But there are people who know this industry and have worked in it, and yeah, we'll push forward those partnerships. That's for sure.
Andrew, fantastic presentation. Thanks so much for joining us. I really, really appreciate it. Good to see you again. And let's catch up very soon. We need to get you back on SF Live and catch up on that. I want to talk down more battery materials in general. Thanks so much, Andrew.
Thanks, Kai.